All right, so the itinerary for today's presentation, we will begin by talking a little bit of theory about the stock scores approach, why I use charts, what fundamentals are, that sort of thing. Then we're going to talk about some of the key concepts to determining when to exit a trade. And we'll begin with something called inflection points. Then we'll talk about trend lines, falling tops, support, resistance. Talk about when to sell our losers and also when to sell our winners. I'll talk a little bit about some of the other education areas that we have on the Stock Scores website and some of the upcoming events that we have. And then we'll take your stock questions where I will go through a number of examples that you asked me about and point out when the exit signals were, or if there has been no exit signal yet, what to watch for as an exit signal. So I'm going to try to do lots of real examples at the end of the presentation so we can really apply what I teach you in the beginning. All right, so let's get right started with the stock scores approach. So when we talk about fundamentals, what we really mean are, what is the company's business doing? Is it a growing business? Does it have too much debt? Is it got good products that people like, or is it suffering from a bad commodity price? All of these things determine what the stock's price will be. You know, every transaction in the stock market is between a buyer and a seller. If you want to buy 1,000 shares of a stock, someone has to sell those 1,000 shares to you, and the price that you agree on in the market is done through the exchange. So when you say, I'd like to buy Microsoft at $25 a share, someone has to be willing to sell it to you at $25 a share, and the stock market is really the mechanism that matches those transactions up. So why would you be willing to pay a price that someone is willing to sell for? Really, it's because you have different opinions on what the fundamentals of the company are. If you're willing to pay $25 for Microsoft, it's because you think in the future Microsoft's shares will be worth more. But realize that the person selling to you has the opposite expectation. If they're selling to you, they're selling because they think the future price of Microsoft will be less. And that's the wonderful thing about the stock market, and perhaps the thing that's also quite frustrating, is that everyone's got a different opinion, and it really comes down to who has the best information that will be able to predict where future price goes. And that's, I guess, the next key point, is that investors are using information to make decisions. You might do your analysis of the shares of Microsoft and decide that you think it's worth more than what the stock's trading at right now. Someone might analyze the market and the stock and get a different conclusion. They may be using different information than you, or they may just have a different interpretation of the same information. But ultimately, it really comes down to information. And the better information that you have about what companies will make in terms of profits in the future, the better your predictions can be. Now, in the stock market, it's not really fair. There are some people that get better information than others. If you really know a lot about the software industry, or you really know a lot about Microsoft specifically, you've got a better potential to predict where the share price of Microsoft is going to go in the future. Within every company, there's always going to be people that have better information. You can talk about a junior mining company. There's people in the mining industry that will just know more about that company than I would, because I don't know a lot about mining. I know probably more than the typical person on the street, but certainly not more than an expert in the mining industry. So those with the best information have an advantage. And fortunately, when they act, either by buying or selling, they leave a trail for us to follow. And that's really why I use stock charts to pick the stocks that I want to buy, pick the points when I want to buy them, pick the points when I want to sell them. Because everyone's opinion about the company, about the economy, about what's going on in the world politically, all of that information is wrapped up in what people do in the market. If you do your analysis of that little junior gold mining company and you really believe that they're going to hit a big find in their drilling program, let's say, well, you are going to go out and buy that stock. You're going to buy it aggressively, and you're going to push the stock price up because there's going to be more demand for the stock than there was without you. Now, we generally as retail investors are relatively small. You go and you buy 1,000 shares, 10,000 shares. That's not going to move the market. But when the really big investors the ones that tend to get the best information, go into the market and act, they create market activity that we can follow. And so what I do is very simply, I trust the message of the market. When I look at a chart like this, I can tell what the market thinks about the company's fundamentals. So this is a 3-year weekly chart. We're going to go through this chart in a series of steps to learn how to read it and to see exit signals in this chart. And this 3-year weekly chart really tells us how the market's perception of the company fundamentals changed over time. Just bear with me for a moment. Just got to take a quick pause here. Thank you for that. Sorry, I have pollen allergies and I was going to sneeze. So, all right, let's continue on. So this is a visual history of what the market thinks this company's fundamentals are worth. And you can see in 2013, the price went down. That meant that the market's perception of fundamentals was getting worse week after week. And then from the middle of 2013 until roughly the summer of 2014, the price went up. It went from $7 to over $15. So it more than doubled in about a year because the market's perception of fundamental value got better. And then since the market topped out in the early summer of 2014 until January 2015, we saw another pretty dramatic drop. It went right back to where it was in 2013. The fundamentals were getting worse. So in this chart, we're really getting an impression of how information flows from the company, from the economy to the investor, and how the investor judges that information. And once you learn how to read this chart, you can really gain a lot of insight into when to buy and when to sell. And that's what I'm going to focus on today is the second thing, which is when to sell. Now, we did a webinar last week where we talked about some of the reasons to buy stocks, some of the ways we read chart patterns. So this presentation today is on the when to sell question. We've got all kinds of webinars planned over the next month or so. You can go to the StockScores website and see the full list of them from the homepage, and certainly register for as many as you like. Each one is going to have its own lesson. All right, so let's now get into one of the key concepts of reading a stock chart, something called inflection points. Inflection points are the building blocks of chart analysis. They're really the dots that we are going to use to connect to determine whether the stock is worth buying or worth selling. And it's kind of the first real, how would I say, as I say, the building block, the key base concept that we have to use to determine when we are going to enter and exit. All right, so there are the peaks and valleys on the chart. I'll show you that in just a moment. It's really where stock price changes direction. It's easier to understand if we just look at it visually. So what I'm going to do now is mark up this chart with some little dots. This is something, if you own a stock, I recommend you print out the chart, take out a pencil and a ruler, and start off by just highlighting the little peaks and valleys. So there's a peak, there's a valley, there's a peak, and I'm just really just highlighting places where the stock stopped going down and started going up. So here it's going up for a while, there's a peak. Was going down for a few weeks, there's a valley. Going up for a little while, there's a peak. Going down, there is a valley. There is a peak, a valley, peak, a valley, and so on. All right, so you're starting to see these little highs and lows that I've highlighted on the chart, and we call these inflection points. And they're very important because they're what we use to determine when we should buy a stock and when we should sell. We're going to actually start to connect the dots with these inflection points. So moving along now, what are some of the key elements for knowing when to sell? Well, they are 4 things: trend lines, falling top, support, and resistance. So let's go back to the chart and let's start again by using some of our inflection point highs and lows. I'm just going to highlight some of the important ones on here. And we're going to start to connect the dots. So first thing I'm going to talk about is resistance. So this is a price peak right here where for 3 or 4 months the stock couldn't get through that price of about $11. And you can see that it was bumping up against it for a long time, and eventually it broke through. That would be the buy signal for this stock if you were a longer-term position trader. So there in March of 2014, there was a good entry signal. There was another one right here when the stock broke through this price ceiling. And there's a variety of reasons. I'm not going to go into the reasons for buying today because we're going to focus on selling. But that's the concept of resistance. Now, the other concept that we want to sort of focus in on is the concept of support. This is a ceiling price, which is a sort of an upper boundary of what investors thought the stock was worth, but there's also a floor price. If we use the inflection point low right there, we can see that investors didn't think the stock was worth more than about $11 a share, but they also didn't think it was worth less than $10 a share for this time period. All right, so support is the floor price, that was at $10 a share, and resistance was the ceiling price, that was at $11 a share. And I can add more support prices on. There was a support price here. There was a resistance price here. So anywhere there was an inflection point high or low, just draw a little horizontal line like that. All right, so I can draw a whole bunch of lines of resistance and support on this line or on this chart. And they're all basically at inflection point highs and lows. All right, so that's the concept of support and resistance. And we use that both for buying and for selling. Now I want to talk about trend lines. So I'm going to erase all this stuff on here so it's a little bit easier to see. And let's now just highlight some of these inflection point lows. So trend lines are drawn across inflection point lows if you want to do an upward trend line. So I can draw a line across those like that. And I can draw a steeper line from these ones, kind of like that. Okay? Trend lines are important because when the trend is broken, it implies a change of control. So in this time frame, starting in July of 2013 until February of 2014, the buyers were in control, and they stayed in control even from that, after a little bit of a sideways period where it was really a neutral market, the buyers took control again right here, and they really aggressively pushed that stock higher for a number of months. So the buyers were in control here. All right, so here the buyers are in control, and here the buyers are in control. How do we know that they're in control? Very simply, because the inflection point lows that I highlighted to begin with are rising from left to right. If I was to draw all these little inflection points on here, they're all going up over time. So the buyers are in control. So that's an upward trend line. Now, a downward trend line occurs when the inflection point highs are falling from left to right. Okay, so there we can see each top is lower than the previous top. Now think about what that means. If the buyers are strong, they're going to push price up. So here for 4 weeks, they pushed price up, and then the sellers got strong and motivated, and they pushed the stock down for 2 months. And then the buyers pushed the stock up for a week or two, but they couldn't get the stock as high as they had the last time they were strong. And so each time that they're pushing the stock up, which is relatively brief periods here, the buyers generally aren't as strong as they were before. They couldn't push the price up to the highs that they had seen before. And if we go back to this, the concept of fundamentals driving a chart, what it really means is that here they thought the fundamentals were worth no more than $10.50 when just a couple of months earlier they thought the fundamentals topped out at $12.50. And then here they felt that the fundamentals weren't worth more than $8.50. And that's why we can say the sellers are in control. There's pessimism in the market when you have falling tops. Well, there the trend line is broken. And now we start to switch to rising bottoms. Now, what do rising bottoms mean? Well, that bottom there is higher than the previous low. That means that the sellers weren't willing to accept a price any lower than $8 a share. A few months earlier, they were willing to accept $7 a share. Why would you accept $7 a share 2 months ago and then today say I'm only willing to sell for $8 or more? It's because you think the fundamentals are better. All right, so anytime you have rising bottoms on a chart, like we have here, the fundamentals are getting better. And all you have to do is take those inflection points, draw a line across them, and say to yourself, is it going up from left to right, or is it going down from left to right? Now here's the other thing about trend lines. The steeper the line, so I can draw a pretty steep line right there, the more emotional investors are. So when you get a steep trend line, it really means that investors are not only optimistic, but they're afraid that they're missing out on something, that they're really willing to chase the stock higher because they think that the fundamentals are getting so much better. And that's usually what happens before a market tops out. So here you can see that the stock got really steep, and then it did something here called a bursting bubble candle. That's my own name for it. On this particular week, it hit a new high early in the week, but it ended up closing at the low of the week, which is why this candle is red. So it hit a new high, it closed below its open, and at a low for the week. That implies that there was a change of control during the week, and that was really the topping out point for this stock. Now, the final thing I want to talk about is just falling tops. So, and the switch from rising bottoms to falling tops, or falling tops to rising bottoms. So here we switched from falling tops to rising bottoms. This bottom here was lower than this one. So as of this point, the buyers were back in control of the stock. Here we had a new high, and this high, this inflection point, was lower than the previous one, which meant that now we had a falling top. Well, if control is changing in the market from the buyers being in control on this side to the sellers being in control on this side, now you can start to get a sense of when it's time to sell a stock. There are a number of things to look for, and we're going to use support resistance, rising bottoms, falling tops, and trend lines to pick those exit points. So the next thing I'm going to teach you is when to sell your losers. Here's the key thing. You are never going to be right all of the time in the stock market. I have traded for 25 years. I've taught thousands of people how to trade the stock market. I have never met a single person that is right 100% of the time in the market. What we must do, therefore, is have a plan for what to do when we are wrong. If we buy a stock, we think everything is good, we buy it and it just doesn't work out. We have to know, A, when should we take the loss, and B, how much of a loss are we going to take? So to define where we are going to take a loss, we're going to use these concepts of inflection point and support to establish a floor. And if that floor is broken, we're going to exit the trade. So you're going to have to, every trade that you make, every investment that you buy, whether you buy 5 stocks a year for your RRSP or you buy 20 stocks a week because you're a day trader, every trade you should know where the exit door is. And if you hit that exit door, you're going to get out and take a small loss. Because one of the key things in trading and investing is to avoid big losses. You will sleep better at night, you will trade with less fear, you'll make better decisions, and overall you can be more profitable. However, if you don't take your losses at the right price, you may actually be costing yourself money. And so we want to make sure that we pick the inflection point that matters, and also, as I say here, use the right chart time frame for the type of analysis that you're doing. All right, so here is a daily chart of Absolute Software. Now, Absolute Software is a stock that I featured in my newsletter right here on this day. And the reason I did is because it broke through a ceiling price, through that resistance right there. It did so from optimism. These were the things we talked about in the webinar on Wednesday, which you can watch on YouTube, by the way. If you go to the Stock Scores YouTube page, just go to YouTube and search for Stock Scores, and you'll find my YouTube channel, and you can watch the webinar that I did on Wednesday. We talked about why we would buy it there. So I bought it there, and anytime you buy a stock, I go into the trade thinking, well, where should I take a loss? Well, to do that, to answer that question, we're going to look for the inflection point low before the entry signal. So this is my entry signal right here because it was making an abnormal break from a predictive pattern. That's one of the core concepts of the Stock Scores approach. What I then do is say, well, what was the floor price before the entry signal? Now let me first explain what this entry signal means. You had all of these people for a couple of months who were unwilling to pay more than $8.20 for this stock. The stock was trading in a very narrow, quiet range. You can see right there for 10 days in a row, it was trading right around $8, maybe $8.05, maybe $7.95, but very narrow trading range. So the market agreed at this time period that the fundamentals of this company were worth about $8. It wasn't worth more than 820, but it wasn't worth less than 780. All right. And then on this particular day where I've drawn this little arrow, you had investors that were, for some reason, willing to pay more than $8.20. And so in a situation where for a number of weeks, no one had been willing to pay more than that $8.20 price, now you had a large group of investors willing to pay more. And that's why that stock shot up on that day. And notice also that the trading volume on that day also shot up. You know, for a number of months, it traded with volume that was no higher than the line I've just drawn. And then on this day, we get a real big jump in volume as the price breaks out through resistance. Now, I assume, and it's a good assumption to make, that the reason you had investors willing to pay more for the stock on that day was because they had some new information that justified paying $8.50. They said, yeah, yesterday I didn't think it was worth more than $8.20. Today, because I've heard that this company has got great earnings growth or whatever it might be, I think the stock's worth more. Maybe it was a large institutional investor that manages $400 million that said, you know what, we want to buy 1 million shares of this company because we've done our analysis and we think it's worth more. Well, they've just done you a favor because when they went in the market and bought their big block of stock, they told you that they have some good information. And you just have to follow the lesson. Now, what if that information was wrong? What if the reason that they were buying that stock up to 850 was because they believed that the earnings of the company were going to be better in the future? Well, what if that information was wrong? If before that information the stock was worth between 820 and 780 a share, then we would expect that if the information was wrong, it would go back down to where it was before. Makes pretty good intellectual sense, right? So therefore, if the stock were to fall back below this floor price, then the market has told me I'm wrong, and that's where we plan to lose. So we can call that, I don't know, 795 or so. If we buy the stock at 850, we look to the last inflection point low, and that is going to be our stop loss point. That is the floor price where we are going to sell a loser, and that's all there is to it. When you buy a stock, you look to the last inflection point low, and you plan to lose if it goes below it. So if you bought here, what's the last inflection point low? Well, it's right about there. If you bought here, what's the last inflection point low? Well, it's right about here. If you bought here, what's the last inflection point low? It's right about here. So therefore, you would have sold the stock there and kept yourself out of it as it went down right there. So that's really the key. When I buy a stock, I'll buy it in a situation like this, and I'll plan to lose if it goes below my floor. Here's a new breakout. Here's the floor. Here's a new breakout just a few days ago. Here's the floor. All right, so when you are looking to lose on a trade, you're going to plan to lose if the stock closes below the last inflection point low on the chart. That is where we define support. Now, nobody likes to lose, so let's move on to when do we sell our winners. If you have a stock that is doing well, like this one has been, you have to have the patience to let it continue to go up and do well. You don't want to sell your winners too early because they have to pay for your losers plus provide you a return. Consider this. Let's say you're right 5 times out of 10. You have 5 winners out of 10, which means you have 5 losers out of 10. So let's say in a year you make 10 stock purchases. At the end of the year, you find that 5 are winners and 5 are losers. Doesn't seem like a very good track record, does it? But because you're patient with your winners, let's say your average profit is $2,000. And because you take the quick loss as soon as the market breaks down below support, your average loss is $300. Even though you're right only 5 out of 10 times, your winners make you $10,000, and your losers lose you a total of $1,500, which means at the end of the year you've made $8,500 after those 10 trades. So that is what I mean when I say let your winners run and stop your losses short. So when we sell our winners, what are we going to look for? Well, I've kind of given you a little bit of a hint already. We're going to look for stocks that are breaking their upward trend line. We're going to look for stocks that are breaking below the last inflection point low. The formation of a falling top is a negative signal. And if there's a real rapid rise into a strong resistance level, an old ceiling price, we might exit when it gets up to that resistance level. So let's go back to look at a chart. This is the chart of TD Bank. And let's just apply some of those concepts. So first of all, when was this stock worth buying? Again, that was Wednesday's lesson. You can watch it on YouTube. But let me just draw a horizontal line here like this and a line like this. So this was an entry signal right here using my stock score simple strategy. So the stock score simple strategy tells me that that's a good time to buy TD Bank. All right, at that time, I would put my floor price right there because that's my inflection point low, right? And then it makes another inflection point low there, and another one there, and another one there, another one there. Notice that every one of these inflection point lows is higher than the previous one. And if I was to connect the dots, I'd have an upward trend line that looks something like that. Now, when was the trend line broken, and when was the last inflection point low violated? I'll let you look at that chart for a second. It's pretty easy to see right here. So that is when TD Bank broke the upward trend line, and it also broke through that support price at the last inflection point low. That was the sell signal for TD Bank. The buy signal was here at $44 a share, and the sell signal roughly almost a year later, a little more than a year later, a little more than a year later, the sell signal was at $56 a share. So you made $12 a share, which was about a little better than about 30%, 25% return in about a year on TD Bank using nothing more than a ruler and some dots on a chart. Breakout through resistance from a good pattern, that's our buy signal. Break of the upward trend line through support, that was our sell signal. Buy at 44, sell at 56. And since that time, TD Bank has been dead money. It's been going sideways for the last 4 or 5 months. Now let's talk about some common mistakes that people have when they are looking for exits. One of the most common mistakes is that people use stops that are too tight. They will say something like, I'm going to sell the stock if it goes down 5%. All right, so 5% on TD Bank might be reasonable because 5% might represent the difference between here and here, which is where support is. Now let's think about that in percentages. Our buy signal was at 44, stop loss was at 40. Oh wait, that's a 10% move to the downside. If you did a 5% move, you might have had yourself get taken out on that trade because your stop was too tight. So one of the things I want to caution people against is using arbitrary percentages as a stop loss point. Don't say I'm going to sell the stock when it goes down 7%, because 7% for a penny stock is probably too tight. 7% for a large cap conservative stock might be too loose, it might be too wide. What you want to do is still use the stop loss concept, but base it upon the message of the market. Look for those inflection point lows to define support. And so again, if I'm going to buy TD Bank, let's say I bought it here. That's called a flag break pattern. I put my support right there, and that's my risk. I'm going to buy it at 49. I'm going to plan to sell it at 47, $2 a risk. If I bought it here on this breakout, I go to the inflection point low. That's my risk, the difference between those two. All right, so that's how you want to use stops. Now, there's some more things that we want to think about with stops. We'll talk about those in a minute. The other thing, a common mistake, is people simply don't have a loss limit. They just buy a stock, and if it goes down, they hang on to it. Countless times I've heard about people that buy a stock at $5 and it's trading at 30 cents and they still hold it. They have taken no risk management into their investment approach. Every time you make a trade, you must know where you're going to take a loss. Because if you don't, you can have one loser that outweighs the profit of 10 winners. And that is simply because you didn't limit the size of your losses. So that's a real important concept, is to always go into a trade knowing where the exit door is. Don't make it too tight. You got to give stocks some room to move, but don't make it so wide that you take huge losses that outweigh your winners. Another common mistake is the use of trailing stops. They'll say, I'm going to have a $1 trailing stop. Let me explain to you what that means. A trailing stop basically says your exit price will always be $1 if you choose a $1 trailing stop, a $1 behind the high. So in this case, TD Bank topped out there at 44.75, let's say. So if you had a $1 trailing stop, you would have a stop loss point at 43.75. Well, $1 trailing stop would mean that you would have been sold out right there because it went down to 43.75. And by doing so, you got left out of all of this gain because you had too tight of an approach. I don't like to use trailing stops. I like to move my support price up as the stock does better every time it makes a new inflection point low. So if the stock jumps up here, well, now my new inflection point low is there. If it here jumps up, now I've got a new inflection point low there. Now I can raise my inflection point to here and here and here. So just taking that very simple concept that we talked about at the top of the presentation, you're just moving your exit door higher as the stock does well. And if you don't have a stock that's doing well, if you're in a stock that's going this way, well, let's say you bought it here and it goes down to your stop loss point, you get out so that you don't have to endure the big draft as it goes lower. Another common mistake is price targets. I hear this all the time. People will say, well, I bought the stock at $10. I don't want to be greedy. If it goes to $12, I'm going to take my money and run. The problem with that is your winners have to pay for your losers. And I've done a lot of studies that show that most of the profit in your portfolio comes from the big winners that happen occasionally. So going back to our example of 10 trades, let's say you had 5 trades that are winners, 5 trades that are losers. Out of these 5 winners, you might have 2 that are really big winners, and you might have 3 that are small winners. And the 3 small winners might balance out the 5 losers, but it's the profit from the 2 big winners where all your money is made. Well, if you limit the size of your winners by having a price target, you're not going to do as good as you could. Every once in a while, out of 10 trades, you might have 1 or 2 really good winners that give you all your profit. But if you limit the potential size of those winners, then you're not going to beat the market. So don't use price targets. Now, the only caveat on that is if a stock is rising up into resistance. So let's say we have a chart that looks kind of like this. And right here, it makes a breakout from a good pattern, and it starts running up. I know that the 52-week high of a stock is going to be a strong barrier to that stock going higher. So in that case, I might plan to sell when it hits it because there's a very good chance it'll then get stuck at that level. And then maybe if it breaks out later, I can buy it again later. But at least I have sort of maximized my profit by selling it when it gets to resistance. That's the only time I would use a price target for my exit. Now let's talk a little bit about using stops. I had one of our users send me an email saying, I have a lot of frustration with stops and I'd like to learn a little bit about how to use them. So there's some different rules. Let me first explain what a stop loss order is. You can go into your broker and say, I will sell the stock if it hits this price to the downside. So let's say you bought it at $10. You could actually put a standing order with your broker, assuming your broker allows for stop loss orders, to exit the trade if it hits $9. So if it goes down to $9 and trades at $9, the broker's computer system is automatically going to sell the stock for you. In the US, you can do what's called a stop market. So if it hits $9, it's going to sell it at whatever the market price is. And at that point, it might be $8.80, so you might only get out at $8.80. In Canada, you can't use a stop market. You can only use a stop limit. That means you have to set the minimum price you will accept. You could say, if it hits $9, sell it no lower than $8.90. That's a limit order. If it never trades at $8.90, if it trades at $8.80 and then just keeps going down, you're not going to get filled. So it can be a little bit frustrating using stops in Canada because we don't have the stop market order. You're not guaranteed to get out of the trade. With that said, there's a very good reason for that. The Canadian market is not as actively traded. It is not as liquid as the US market. And as a result, it's pretty easy for a stock to hit a stop loss point and then bounce right back and continue its upward trend. And so if you have that stop loss order during the day, let's say, you had a chart that looked like this, and you broke out and you had your stop loss right here at $9, you bought at 10. And you said, if it hits $9, sell me out. Well, sometimes the stock will go down, and during the day it'll go hit 9, but then by the end of the day it comes back to close above 9. You've been taken out of that stock because you had a stop loss order in, and then the stock just keeps right on going and you're not in the trade anymore. And that's a frustrating thing. Why does that happen? It's mostly because the stock isn't very actively traded. If you had one person that wanted to sell 5,000 shares, they just hammered them out, that stock might drop 20 cents because that person is selling a 5,000 share position, and then it comes right back because the buyers step back in and protect the stock, and they see it's a bargain and they buy it up before the close. So you didn't really get a true exit signal because it didn't close below support. So this is where we get into the difference between hard stops and stop on close. A hard stop is what you would enter with your broker. You go to your broker system and you say, if it hits $9, sell it. And you can do that as a market order or as a limit order. A stop on close is not an order that you make with your broker. It's something that you manually execute. And what I would do is every evening I would check my portfolio of stocks, and if one of them has closed below my support price, if it has closed below the last inflection point low, then I'm going to sell it. I'm going to dump it and move on to the next one. So I really encourage people to use the stop on close concept. There is some downside though. If you say if it closes below $9, I'm going to sell it the next day, you may not get out at $9. It may close at $8.80 and the next morning open at $7. So there is added risk when you use the stop on close concept. However, you're also less likely to get those whipsaws where you get taken out of a stock just before it goes right back up again. The only time I would use a hard stop is on stocks that are extremely liquid, extremely actively traded. Stocks like Apple, Microsoft, they're so actively traded that you can rely a little more on the market not giving you a false exit signal during the day. As that stock is moving higher, it is better to modify your stop than to have a trailing stop. So as the stock is going up like this, manually say, well, it made a new inflection point low here, so I'm going to put that as my support price. It made a new inflection point low now there, so I'm going to use that as my new support price, and so on and so forth. So as the stock makes steps upward, revise your exit door to a higher price. And when it closes below that exit door, sell it before it does this. All right, so what I want to do now is invite you to give me some stocks that you own, and we're going to look for the sell signals on them. Now, some of them may not have sell signals. I'll tell you what to look for. But start posting some symbols. Please give me the symbol. It makes it a lot easier for me. While I'm allowing everyone to do that, I'm going to just give you a little bit of information on some of the education stuff that we have on stock scores, and then we'll come back to looking at these charts and really applying what we've learned so far. So on the Stock Scores website, there's something called the Education Center. It has 4 functional areas. The Getting Started area, which is basic lessons about the market. So I'll just jump over to Stock Scores now and show you that. So if I go into Education and click on Getting Started, there are about, 10 or so lessons that talk about different concepts that I think are basic concepts. So if you want to learn the basics of charting, there's a video that explains that. If you want to learn how the stock scores indicators work, there's a video that explains that. The next step up is the foundation area of stock scores. The foundation has, I think, 14 different modules, each one teaching a different concept. So here is a module on exit signals. What I've done today is the tip of the iceberg. If you want to know all of the details of my exit rules, then you would read the lesson. Okay, so there's this long lesson here. And some of the things we talked about today, like trend lines, falling tops, that's all in the lesson. There's also a video that explains it. So I can click on the exit signals video, and it will bring this up, and I can hit play. And just jump forward a little bit here, and there I'm talking about trend lines, right, what we talked about today. I can make this full screen, and you can hear my voice in the background probably because I'm actually listening to this. I'll pause this now. Once you've done the written lesson and watch the video, you are ready to do the assignment. So there's a little assignment here on trend line breaks. The first question, identify the upward trend line breaks on the following chart. I'm getting you to apply the lesson and what that particular concept is. And then finally, there's a little multiple choice test so that you can test yourself in your understanding of the concepts of that particular module. So you can see that there's modules on reading chart patterns, price channels, exit signals, how to do risk management, what this concept of the expected value of the trade is, how to use stops, time. I mean, there's all kinds of them here. All of these lessons give you the foundation to understand my strategies. So if you want to learn more about how to buy position trades for your longer term portfolio, there are lessons for that. So my favorite strategy for picking stocks longer term is the Stock Score Simple Daily or the Stock Score Simple Weekly. And there is a written lesson that explains the rules, and there is a video that highlights me teaching you the rules. Just like I'm doing today as a webinar, I've recorded a video that teaches that. And then you can always ask me questions by email. So that's the layout of the Stock Scores Education Center. The way you work through the process is you begin by reading my basic book, The Mindless Investor. Then you move on to the foundation lessons, which will teach you the core concepts to being able to trade my strategies. And then you can decide whether you want to be an investor, longer-term trader, or an active trader, someone that wants to day and swing trade the market. I've got strategies for day and swing trading, and I've got strategies for investing. If you want to become a Stock Scores investor, or if you want to become a Stock Scores active trader course, do that course, it's all online. And you simply purchase the course, you do all your education online, it's going through modules, there's tests, some of the assignments, your final assignment, which is a trading plan, you'll actually send to me, and you're going to focus in on position trading. You're going to learn how to use our tools. On Stock Scores, we have a whole bunch of tools, but the key one is the market scan tool. I can go in here and I can do a market scan for the Stock Scores Simple strategy on the Canadian market. Click on that, run the report, and there it found 21 stocks that meet the criteria. I then go through these charts to visually inspect them to see if they have an entry signal. And when I see one that I like, I can click on the chart, blow it up, and say, yeah, that looks pretty good. The stock's breaking through resistance. Not really ideal. I'd rate this one about a 6 out of 10, but that's the process. And what you're learning in the investor section of the Stock Scores website is what the rules are for what to look for. Now, if you want to be an active trader, let's say you want to be a day and swing trader, it's just a different set of lessons, a different set of strategies. Concepts are all the same, but now you're focusing on strategies to pick stocks to day and swing trade. So if I go back to the market scan tool, I can run my market scan, run what's called the day trader scan this time, and run that. So there were the stocks that on Friday were worth day trading. You would run this scan shortly after the market opens, and you then just check the charts to see if they have an entry signal. So I can look at the chart of General Electric, and I can look at this as a 2-day, 2-minute chart. And one of my strategies, something called an intraday pullback play, gave an entry signal on General Electric right there, about middle of the day, and it went for a pretty good run into the close. As a day trader, you make $1 a share on that trade, 4 or 5%, but that was only in 3 or 4 hours. So that's the concept behind day trading. And what you learn in this course is what the rules are to do that. Each lesson module on the Stock Scores Education Center Foundation has a written, a video, an assignment, and a test. And then the actual strategies have a written component and a video component. The cost to doing this, if you want to register for these courses, the foundation course is $995. That'll get you the core concepts to being able to trade my investor strategies. If you take the investor course, it's $2,495. That gives you my investor strategies. It also gives you all the foundation stuff. If you want to be a day trader or a swing trader, which is short term, then you would take the active trader course, which is $34.95, but you also get this and you also get this. So this is basically top of the ladder, but day trading isn't for everyone. So if you have no interest in day trading, don't waste your time with the active trader. Just do the investor course. If you do the investor course and you want to upgrade to the active trader, then the upgrade fee is $1,250. And the upgrade fee from the foundation to the investor is $1,745. However, I'm going to tell you in a moment how you can get a better deal. Desjardins is a brokerage house in Canada, Desjardins Online Brokerage, and they have a partnership with us, basically subsidizing the education that we offer. If you are their client or if you become their client, you can get pretty good discounts on our education. The foundation course, instead of being $995, is now free if you are one of their clients, or if you open an account next week, let's say. If you do the investor course, it's $1,000 instead of $24.95. If you do the active trader course, it's $2,000 instead of $34.95. Plus, you get free access to the market scan tool, which was that tool we were using here. So instead of having to pay $29 a month or $300 a year, you get access to that tool for free when you are a client of Desjardins. So what I'm going to do now is let Wayne talk real quickly about Desjardins and what they do. He is the Western Canadian Regional Manager. He's going to talk for 2 minutes, and then we're going to come back and we're going to start analyzing stocks. So while he's talking, I'm going to start to look through these questions here, and we got a ton of questions, so we'll try to get through as many as we can. Wayne, are you there?
I am here. Can you hear me, Tyler?
I can hear you, so fire away.
Perfect. And I suffer, as you do, from seasonal allergies, so I know what you're going through. I'd first like to thank everybody for joining us today, and also thank Mike Campbell and the Money Talks team for their support. And we're pleased to sponsor the Stock Scores Education Series. Desjardins is safe. We are part of the Desjardins Financial Group, which is the 6th largest financial institution in Canada, and we were recently awarded or rated in a Bloomberg Markets report as the 2nd safest bank in the world. If you want to read that article, just Google Desjardins Safest Bank and you'll find the Canadian Business article. To put that into a Canadian perspective, TD is mentioned in the article as the 5th safest bank in North America, but that didn't even crack the top 20 globally. This is important for you with the past financial crisis when we saw several large financial institutions go insolvent. It can help you sleep better at night knowing that the financial firm you do business with is rated very safe. We're also a member of the Canadian Investor Protection Fund. Number 1 in customer satisfaction. Desjardins has been awarded number 1 in customer satisfaction by J.D. Power and Associates. We've had the number 1 spot 4 out of the last 5 years, and really a great customer service and great customer experience is what we strive for. And we will be there for you from the time of opening your account and transferring your assets to supporting you using our platform and tools. Reliable, cost-effective service. We were the first discount brokerage in Canada, and we've been in business for over 30 years. This experience translates to a reliable platform you can count on. We offer real-time streaming quotes and fast execution. Disnet is a direct access broker, which means your trades hit the market in 1/10 of a second. And active traders can trade for as low as $5, which even if you're not an active trader, you can trade for $9.95 flat equity fees. Powerful tools and education. Well, that's really why we're here and sponsoring the Stock Scores Education Series. At Disnet, we know how hard it is to consistently beat the markets and manage your account, so we're committed to bringing you the most powerful tools. And not only offering the Stock Scores Market Scanner, but giving substantial discounts on Stock Scores education to our clients for people looking to take their knowledge to the next level. I'd encourage you to go to our website, disnet.com, for more information, to sign up for a demo, and view all the information on our platforms. Thanks, Tyler.
Thank you, Wayne. Great to have you on again. I'm just going to do a quick poll. Usually what I would do in the past, I would just put up Wayne's email address, but we found it's easier if you just answer this poll. If you would like an email from Wayne, sorry, I hit the wrong button there. If you would like an email from Wayne to basically get some more information on what Desjardins Online Brokerage has available, what the discounts are, all that kind of stuff, they'll fire that email out to you on Monday. So it's just the best way for them to communicate with you. I'll just pass along your email address from your registration for the webinar today to them, and then they'll fire you one email next week, and you can follow up with them if you choose. So we'll just leave that up for a moment. We are going to go through a number of stock questions in just a second. But I'll just leave this up for a moment. And as I said, if you want to post your stocks on here, I'm going to try to get through as many as we can. We have hundreds of people in the webinar today, so I'm not going to be able to get through everything because there's just so many being posted, but I will do my best and also just try to teach you a little bit about reading charts and looking for exit signals. So I think everyone's going to benefit from that. All right. Just leave this up for another moment here. I'm going to talk quickly about the class we have coming up in May. So in May, I will be teaching a live online class. So in addition to the online stuff that we have in the Education Center on stock scores, I'm going to complement that with some live online training for people that purchase one of the classes. So if you want to do the investor course or the active trader course, there's going to be some extra options there. So I'm just going to close the poll now and just talk about that. So on Saturday, May 23rd, we're going to begin with what is called the foundation overview. For about 3 hours on that Saturday, 9 till 12, I'm going to walk you through all of the foundation lessons and kind of put everything together. People find that really helpful because they can go through the individual modules on their own, but it's nice to have me sort of put it all together, big picture, to see how all these things interrelate. So that's what we're going to do on Saturday, May 23rd. Then on May 25th until Thursday, May 28th, each evening for about an hour for the investor students, I'm going to do a 1-hour market scanning session where we're going to use that StockScores market scanner and look for stocks to buy and apply the strategies that you have learned. So it's kind of like being able to sit beside me as I do my research each day. I'm going to do my research with you watching and really just stress what to look for using the strategy. So that's a real valuable thing. For those that do the active trader course, I'm actually going to day trade the market live Monday to Thursday for the first couple of hours each day. You log on with the market open, and 80% of our entry signals come in the first 2 hours of the day. So that's what we're going to focus on, just going through the processes to find the day trades, to find the swing trades. I'll buy these things with my capital. You'll watch me make the trades. You'll be seeing my screen as I go through the process. So again, a real valuable way to take the theory that you've learned in the course material and actually see it applied. So that's coming up in May. To be eligible for that, you have to register for the active trader or the investor course before May 15th. So I'm going to put up a poll in just a moment. If you have an interest in learning more about the upcoming classes in May, just answer this poll, and again, I will fire out an email for you next week that'll give you some more detail about this upcoming May class. Certainly we don't do the hard sell or anything. If you want me to send you the email, I'll send it to you, and if you want to register for the class, you can do it online. You can ask me questions. I'll have my email address in the email that I send out. And that's a great way to sort of get a little more insight into what the active trader course is, what the investor course is, and what are the benefits of being part of that May class that's coming up. I won't have one for a while after that because I take a break through the summer, so probably won't have another one until late fall. So if you want to learn how to do this, get yourself sort of taught over the summer, it's a great time to do it. Not a lot of time required. You're going to put in a little bit of time that week of May and then practice basically after that. So I'll leave that poll up for just another moment, and then we're going to start to review these stock questions that you've been posting. One other point, we have a website page where you can learn more about the StockScores education packages. That's at stockscores.com/learn. If you go to the StockScores website, there's a link to it right there on the homepage. I'm going to sneeze, and then I'm going to remove this poll, and then we're going to get down to the stock questions. Excuse me for a moment. All right, gotta love the pollen. Okay, so I'm going to close the poll down now, and then we're going to get to analyzing some stocks. So I'll just close this down. And if you're watching this as a video, because I am recording today's presentation, if you're watching this as a video and you didn't get a chance to request that I send you an email, you can just fire me an email next week. Here's my email address on screen. It's going to come up in just a second here. And there we go. You can see my email address there, tylerb@stockscores.com. Write that down. And there's also the web page online where you can learn more about our upcoming education stuff, stockscores.com/learn. All right, so now it's time to analyze some charts. And really, this is where we're going to get a lot of our lessons learned from this. I'm going to begin with a couple that were emailed to me before the presentation. First one is Pivot Technology Solutions. So this is a strong stock. The person that sent this to me, I'm assuming, bought it. I don't know when he bought it, but there was a couple of entry signals here. There was the first one right there, this abnormal price break from sideways trading. Then there's something called a pennant break right here. And flag break there, I was getting a little late. I don't think I would have chased it higher there. So if he owns this stock now, where is support? A couple of things we can do. We can look to the last inflection point low, which was at 38 cents. So that would be our current inflection point low. The other thing we can do is draw a trend line, connecting the dots, drawing a trend line across here. Now what I'm going to do to help you see that is I'm going to use a little program I have called Snagit. You can get it from snagit.com, snagit.com, and it's a little program you install, and what it does is it allows you to draw on anything that you can snag from the website or from anywhere on the web. So I'm going to just take out my line drawing tool here. So if I was to draw a trend line right now, it would look something like this. So if on Monday this stock closed below 44 cents, it will have broken the upward trend line. And so that would be one sell signal right now. I consider this stock a hold, but it's probably going to pull back. Notice on Friday, it opened at 52 cents, went up to 54 cents, and then went down after that to 48, and it closed at 49. That's how we read these colored candles, and that's something that's taught in the Stock Scores Education Center and how these colors all work. So the basic idea here is it opened at 52 and it closed at 49. That means it closed below its open on a day when it was trading very strong volume. That is a short-term sell signal. That's something called a bursting bubble. So if I was a real short-term trader, I might sell it Monday morning with the idea that I can maybe buy it back on a pullback. I still like the stock long-term because it's in an upward trend. It certainly hasn't violated the inflection point low support at 38 cents, so that's sort of how you want to look at it. So the first few stocks that I bring up, I'm going to go through fairly in depth, and then I'll go through them a little bit more quickly as we move through these, just so I don't take all day to answer your questions. So on this one, also a very steep upward trend. Here's another trick that I'll use when a stock is moving up so quickly like this, because really, where's the last inflection point on this chart? It's really way down here at 26 cents. Well, it's at 50 cents now. I don't want to have it drop all the way to 26 before I exit. So when I have a stock that's moving up very quickly like this and really being a great performer, I will look to the intraday chart for areas of support. So this is now a 30-day 120-minute chart. I can make it a 60-minute chart by clicking on the little 60M here. Now that's an hourly chart going back a month. All right, so now where's the inflection point on that chart? The last inflection point. That would be right here at just under 40 cents. So that right now is support. If I was to draw a trend line, I would draw it across these inflection point lows, and that would be right about 42 cents. So the aggressive exit point on this stock would be a close below 42, and the more conservative one would be a close below, looks like 39.5 cents. All right, so let's pull up some more charts here. T.PTM. Okay, I'm just going to look at the, so I'll just read the question because I think it's important to understand the context. T.PTM bought at 69 cents. Have noticed the stock scores have gone down. Wondering if I should hold as the stock has been steadily rising for the last 3 months. Are the sellers now in control? So first thing, we don't use the stock scores for exits. We use the stock scores for entries only. And there is a video on the stock scores getting started area that explains what these indicators are for and how they work. So I encourage everyone to go take a look at that. The stock has gone down for the last 4 or 5 days a little bit, and that's why the stock scores have dropped a little bit. But big picture, we have rising bottoms. This bottom is lower than this bottom, which is lower than this bottom. So it's trying to turn around. If you look really big picture, look at a 3-year weekly chart, this is an ugly stock. This stock has been beat up like every commodity stock has, and it's really not a long-term buy. Short-term, maybe as a trader, if you're able to move in and out fairly quickly, okay, it's got some potential because it just broke through resistance. I personally would not have bought this stock. It doesn't fit my rules. Is it bad? No, it's better than neutral. I would say it's slightly good, but it's not a great stock. Now, if you own it now, where would the support price be? It's at 60 cents. That is our last inflection point low. So if it pulls back and closes below 60 cents, you will have an exit signal on this stock. Okay, is it a good idea to monitor day to day around 10 minutes before the close to see if we need to sell? Yes, so that's one thing you can do. Let's say you owned, I don't know, BlackBerry. You could check it each day to see if it closes below your support price. And if it does, you can sell before the close. The alternative to that is checking in the evening, and then if you have an exit signal, sell the following day. I don't know that one is necessarily better than others. I think it's more a matter of what fits with your schedule the best. So that's how I would sort of approach exiting stocks in that regard. All right, what's the next one? RTN. Let's take a look at RTN. And I'm gonna probably miss a lot of the symbols that you guys have posted for me. I'm just going to try my best to get through as many as I can. So Raytheon is a strong stock. It's moving up from left to right. It's got rising bottoms. That's great. Where's the last inflection point low? Right there, which we can get real detailed. If we look at the 1 month chart, we can see that low was about 106.50. So 106.50 I would consider to be support right now. If it closes below 106.50, I would sell. I'm a little bit concerned about it because this top might be we might be forming a falling top here if it started to break down, but it hasn't done that yet. So right now it is a hold, but you want to keep an eye on that. Let's take a look at TJX. Okay, so this one in a good upward trend, moving up from left to right, that's a positive. I would say support is right here, just under $67, so that's where I would exit that stock. You could also draw a trend line. So if I take out my little snag it tool, and I'll draw on this for you all to see. When you're drawing trend lines, real simple. Start off by looking for the inflection points. So there's one, there's one, there's one, there's one. And then just draw a line that fits it best. So I would draw my trend line kind of like that. Okay, that best, I mean, it's an art, it's not a science, it doesn't have to be exact, just try to do it that way. And that's where trend line support is. If you use support based on last inflection point, you're going to go right about like that. So really, to pick exit points, all you need is a ruler. Print the chart out on your computer's printer and draw on it with a ruler, or get the snag it tool. It's 50 bucks. And that way you can pull any chart off of any website. You can use my website because our charts are beautiful. That little plug there. Just draw on the charts that way. Okay, let's go back to stock scores and pull up some more. Someone's asking me about Apple. So inflection point low on Apple right now. The last inflection point is just a little above 122. So a close below that would be an exit signal. Now let's say you're a long-term investor. You've held Apple for 3 years. If you're a long-term investor, you shouldn't be looking at a daily chart. You should be looking at a weekly chart. So take a look at the 3-year weekly chart. And now I would say, well, the inflection point on the 3-year weekly chart was about 5 weeks ago at that low, looks like about $122 a share. So longer term means you're going to give more room for the stock to move around. But if you take a look at this long-term weekly chart, you have had a series of rising bottoms since March of 2014. So this stock has been just on a nice, steady upward trend. It hasn't had a falling top. It hasn't had a breakdown through an inflection point low on the weekly chart in that long. If I'm a day trader, I'm not going to look at this chart. It's not the right chart for me. If I'm day trading the stock, I'm looking at the 2-day, 2-minute chart. And there on Friday, you can see steadily rising bottoms all day long. So that would be, if you bought this on Friday as a day trade, you would have held it through the day. If I'm a swing trader, I'm going to look at the 15-day, 30-minute chart. And I might say, well, steadily moving higher over the last week, still no reason to sell. So you have to use the chart time frame when you're looking for these inflection points and trend lines based on the style of trading that you do. Okay, let's take a look at T.SVC. So right now, support on this would be at 350. If it closes below 350, I would sell. You want to get a little more aggressive, go 360, but that's where I would put it right now. It is a good hold. Stock is moving up from left to right, so I would hold it if you own it. T.DRT, The stock has been doing real well, made a breakout from a sideways trading range back here in January, and it's just had a steadily rising bottoms. So this one is a stock that's done so well that we want to get more aggressive with our exit because it's going parabolic. The trend is getting so steep to the upside that you want to be more aggressive. So what I would do is look at the 1 month 60-minute chart and look for the last inflection point low. I would say 655 or so. That's where I would put support on it right now. All right, ConAgra. It's a good hold. It's moving up from left to right. That's important. I think I go my inflection point at just under $36. Again, you want to see a little help to see that. Go look at the 1 month hourly chart. There you can see that inflection point low at 36. You want to get real aggressive, 37.50, because you did have a little inflection point there. But that would be, if you bought it as a swing trade at $34, you'd be looking to lock in that profit. Okay. MMT. So MMT support right now at 630. I don't really see a great reason to own it. You might mean MMT on Toronto, which is in a downward trend. So this is a stock to avoid right now. But if you did own it, I would sell it if it closes below 45 cents. Let's take a look back on this chart farther. And here you can see the cycle of rising bottoms was broken right here. That's when the upward trend line was broken. Then you had a breakdown through support right here from a falling top. So I'm trying to put together all the little pieces we talked about. So you had all kinds of sell signals last summer on Mart Resources. And you're out of that stock at anywhere from $1.20 to $1.40, and you're not sitting in it at 50 cents anymore. So that's why I say you got to get out of these stocks when they start to move down with some momentum. ADXS. Okay, this is a trend that's going parabolic. So look at a 1 month 60-minute chart. And gosh, I would use an upward trend line. I'd be real aggressive selling this stock. If it closes below $19, I think I'd take my money and run on it because it is due for a pullback. You can buy it back later. Sell it at 19. You might be able to buy it back at 17 if you really like the company. Now, if it goes up to 21, then don't sell it at 19. Just keep raising your stop up as it moves higher. CDXS. So in at 479 with a stop at 450. So let's take a look at the 1 month. And I think 450 is a good place to have your stop. I would use a stop on close, so it would have to close below 450. And yeah, I think it's a good hold. I'm not crazy about the buy at 479 because it's a little late in the trend. It's been trending higher for a while, but if you already own it, I think you've got the right support price for it. WEF, maybe T. If it's a Canadian stock, I have to put a prefix in front of the symbol. So this is a stock that is negative. It's moving down from left to right. We have pessimism. So I think it's a stock to avoid. Right now, support is at about $1.77. If it breaks down through $1.77, I would sell it. But I really don't see a reason to own this stock right now. Going back a little farther, here you had a parabolic trend. Break that parabolic trend there. And then a break of this upward trend line around 230. So I think this is a stock that's more likely to go lower than higher right now. Leg, I'm going to assume you mean Canadian leg, which is Legacy Oil and Gas. It's trying to base right now. It's broken its downward trend. It's starting to switch to rising bottoms from falling tops, so that's a good sign. Support right now at about $1.50. So if it closes below $1.50, I think it goes down and maybe retests $1. Okay, I just got to cycle through some more questions here. We got lots. Oh my goodness. I won't be able to get to all these, but I'm going to do my best. So I'm going to go through them a little quicker. AMAG, whoops. Support right now at 52. Good upward trending stock, definitely a hold. If it closes below 52, I would sell. Neon. Stock's going parabolic a little bit right now. So let's take a look at the 1 month. And I would say support right now at 343, 345, right where I'm moving my cursor. So anytime the trend gets real steep, take that shorter term view of it. T.kel. So right now support, I mean the inflection point is about 670. I think that's a little far. I would probably, let's just take a look at the, yeah, I think I'd probably have support in around 720 right now. It is trying to build some upward momentum. That's good. It's fighting against a long-term downward trend, but I think if you own it, it's a good hold. You can see the stock scores are getting better, so it's trying to turn around. And as I said, I'd put that support around 720. ZWU. T.ZWU. Let's try that. There we go. Not something I love. The buyers are not in control of this. It's kind of a neutral. This is an ETF. I would say it's neutral. Support at about $15. XSR. T.XSR. All right, this one support at 540. It still is going to have some trouble getting through that 640 resistance level. I don't think it's a great stock to own, but if you're already in it, I would have support at 540. Royal Bank. So it's all the banks made a little bit of a comeback last week, and that really helped the TSX look a little better. Support right now is at 74 and a quarter, whatever that price is there, roughly 74 and a quarter. Big picture, the banks are still stuck in a sideways trading range. If we take a look at a 3-year, you can see, well, actually, they're trying to break that pullback. Yeah, I actually don't mind TD or Royal Bank today. I didn't look at this chart until just now, and they definitely made a good performance last week that's breaking what's called a flag pattern. And so you may see the bank start to do better. Royal Bank looks not bad here. I'd put support at what I said, 74.25 or so. Intel. Intel, I think, is a stock to avoid, falling tops from left to right. If you own it already, support at $30.50. SZYM. So this stock is one of my features right now. I like it because it made this abnormal break about a month ago, and it's trying to basically turn around from a long-term downward trend. Right now, support, I'm going to zoom in on this a little bit because it's a little bit distorted. I think I would keep support down around 280, around $2.80 right now on SZYM. HMHC. Yeah, I like this one. Good upward momentum, trying to break to new highs. Support right now about 2270 or so, wherever that low is there. TRVN. Nice break back here. In a little bit of a pullback phase right now. I would put support at about 630 or so, wherever that floor is there. If you want to be a little bit more conservative, keep it at 520. Let's take a look at the 3-year. Yeah, you know what? I'd keep my support down here a little lower, 520 or so. What do we got? I got so many symbols, I'm getting lost where my eyes have to go. Let's try RNDY. So good upward momentum on the stock, getting a little bit parabolic. Let's take a look. It kind of depends what style of trading you're doing with it. If you're a long-term trader, trading off the 3-year, I think you have support at just under $4. If you're more of a swing trader, because it did come alive this week, as a swing trade, I would have support at 540. So again, it depends how you're trading it, and that's really the case with all these stocks. I'm assuming you're sort of taking these as longer-term trades, but it may be that you're looking at them on a short-term basis. Element Financial, nice upward momentum. I think a great stock to hold. Not a stock to buy, but a great stock to hold, and support at about $16.60. I think I looked at this one already. Yes, I did. SVC we already did. It's interesting to see that a lot of people are asking about the same stocks, so you're jumping into stocks that are doing well. Let's take a look at V.PTK. Also one of my feature stocks, made a nice breakout recently. A little bit of a pullback on Friday. That's normal after a stock makes a break like that. I have this as a longer term position trade, and I think you still keep support down just below $1.40. AQXP, I'm going to do 5 more or so, and then we're going to have to wrap it up for the day because it's getting a little long in the presentation. I like to keep the presentations around an hour. This one's getting a little long. So support right now 750, just under 750. Not a great looking chart though. It's had some bit of a breakdown there, so I'm not crazy about that one. Geron. So this was a stock that I talked about on Michael Campbell's radio show this morning, and I like the break of the flag. I own this one, by the way. Nice break of a flag on Wednesday. This stock probably continues higher. Support right now just under 360. T.GIL, Gildan Activewear. I like this. Nice break from an ascending triangle recently. I'd put support at 37.20. Even a stock to consider on an entry now. It's been going up for a long time, but it's just got great upward momentum. Northern Tier Energy. I put a neutral rating on this stock. It's not a great looking chart, but if you own it already, support right now is just under $24. Now, if I do miss your question, I can see that people have asked me some questions as well. And if I don't get a chance to answer it, please don't hesitate to email me. I'll put my email address up again in a moment. But I'm not going to get to everyone's question. I'm going to do a few more stocks here. Let's do V.GRC. Hopefully by now you're seeing that this isn't really that hard. You just look for inflection points. So where's the inflection point in this one? 70 cents. That's the last point where it stopped going down and started going up. You can pull up any stock. Let's pull up a couple more here. Here's Kamiko. Okay, where did it stop going down and started going up? 1750. That's support. Is this a good stock right now? No, because it's in a situation where there's falling tops. So the sellers are in control. Until that changes, I wouldn't consider it. CGen. Tops are falling from left to right. Stock I would avoid. Support right now, very tight, 690. Now, someone's asking me about my YouTube channel and how the videos are in a random order. I think there is a way to sort by most recent. It's one of the ways you can sort the videos. So if you go to the stockscores.com channel on YouTube and you want to see my most recent video, sort by post date or recording date, and you should be able to see the most recent ones at the top of the list. One more stock. This is a penny stock, NSP. That's not it. Let's take a look at Venture NSP. There we go. So this stock's been going straight up, so I'd want to be very aggressive with my exit point. To be aggressive, look at the intraday chart, and I'd have support right now at 70 cents. I'd even get more aggressive. I'd probably put support at 85 just because it's gone up so quickly. All right, I apologize for my stuffed up nose and sneezing. I do have an allergist who gives me good stuff, but for some reason it's not working very well this morning. So I want to thank you all for joining us today. We had a big group in here and I had too many questions to answer all of them, but I've done my best to get through lots of them. Here is my email address. Don't hesitate to ask me some questions about our upcoming classes that way. You can follow me on Twitter at StockScores. I post comments throughout the week on Twitter. And there is my YouTube channel. Go to YouTube and you can see lots of free videos on there as well. If you answered yes to wanting to get some more information on our upcoming courses, I will email you that information the next day or two. And otherwise, if you want to take in more of these webinars, go to the StockScores homepage. So go to Home. And right there is our whole webinar schedule. If you click on this little blue button right here, you can see all the webinars that we have coming up and take in as many as you want. They're all free, and I hope to see many of you again. Different topics, so definitely watch. I'm even going to do one where during trading hours not this week, but the next week from 11 in the morning Pacific time, I'm going to just kind of show you what I do for an hour during the day. So if you have an interest in day and swing trading market, that's going to be a fun one. Thank you very much, everyone, and I will see you at future webinars. Hopefully you have a great weekend. Have a good day.